Good evening, everyone. It's 11:24 p.m., the 1st of July 2025. My name is Sam Ismail, and today, along with my colleagues Krolos and Norris, we will be representing our analysis of Germany's foreign direct investment landscape. To begin with, let's take a look at Germany's economic fundamentals. Germany has a GDP of approximately $4.5 trillion, stands as the world's fourth largest economy and the largest in Europe. However, it experienced a modest growth rate of 0.2% in 2023, largely due to energy prices shocks and a slowdown in demand from China. On a positive note, inflation has been on decline trend, falling from 6.9% in 2022 to about 2.8% in 2023, thanks to the European Central Bank's measures and stabilizing energy prices. Germany's population of 83.2 million is highly productive, though it faces demographic challenges with a median age of 45.7 years. In response to recent economic shifts, Germany has launched a 200 billion defensive shield to ensure energy affordability. There are also significant investments being made in green technology and semiconductors, with major projects from Intel and TSMC underway. Furthermore, Germany's innovative and transparent environment is reflected in its rankings: 8th in the 2023 Global Innovation Index and 9th in the Corruption Index. In slide number 5, we'll be talking about Germany's economic fundamentals and why it attracts FDI. So, what makes Germany so attractive to foreign direct investments? A breakdown of its economy by sector provides some answers. The service sector is the largest, contributing about 69% to the GDP, with major opportunities in finance, logistics, and tech. Manufacturing, the backbone of its export economy, accounts for around 23% and is dominated by the automotive, machinery, and chemical industries. The construction and agriculture sectors, though smaller, offer niche opportunities in smart infrastructure and agri-tech, respectively. Into the next slide, we will be speaking about key investment drivers. So, diving deeper into the key investment drivers, we find the Mittelstand, Germany's small and medium-sized enterprises, which are world-class partners in niche engineering. Germany is also an R&D powerhouse, investing 3.1% of its GDP in research and development, with major hubs in Berlin, Munich, and Dresden. The government's push for a green industry is backed by 177 billion euros in incentives for climate technology, hydrogen, and electric vehicles. Strategically, Germany's access to the EU market of 447 million consumers is a massive draw, with exports accounting for 47% of its GDP. Finally, strong institutional frameworks, including low corruption and robust intellectual property enforcement, make it a secure place to invest. Into the next slide, where I'll be explaining the demand and supply analysis for FDI. From a demand perspective, Germany boasts high consumer purchasing power, with a GDP per capita of approximately 49,000 euros per person in a year, and a strong domestic market of 83 million people. There's significant demand for high-quality, tech-enabled, and ESG-compliant products, as well as government and corporate demand for green energy and infrastructure modernization. In fact, Germany had the highest household consumption in Europe in 2022, and you can see this in the bar chart that attached to this slide. On the supply side, the labor market is characterized by low unemployment, around 5.5% in 2023, and highly skilled, albeit aging workforce. While there are skill gaps in healthcare, engineering, and digital sectors, the country's high R&D intensity and strong capital markets are significant advantages. However, challenges remain, including energy shocks following the war in Ukraine and a lag in digital public infrastructure. Germany's economic sentiment versus the EU. Okay, into the next and final slide. For me, I'll be talking about Germany's economic sentiment versus the EU. Finally, let's consider the economic sentiment. The economic sentiment indicator, which measures business and consumer confidence, shows that both Germany and the EU saw a sharp decline in early 2022 due to inflation and energy shocks. This was heavily influenced because of the Russia and Ukraine war. By November 2022, the sentiment in both had dropped to 94.3, while the EU sentiment has since recovered to around 98 to 99. Germany has been more volatile and has remained lower than the EU average, which can be seen in the graph in this slide. The slight recovery in early 2025 suggests a cautious but improving outlook, signaling a potential opportunity for investors to get in ahead of a broader economic rebound. I will now hand over to my colleague Norris, who will discuss the theoretical underpinnings of Germany's growth and its policy landscape.
Thank you, Sam. My name is Nauras, and now I will connect Germany's investment strategies to establish economic growth theories. Germany's significant investments in semiconductors, hydrogen, and AI are increasing its capital, stock, and technological capabilities. In the context of production possibility frontier model, this pushes the frontier outward, enabling Germany to produce more goods and services efficiently. In the solo growth model, an increase in capital and technology leads to a higher potential output. Foreign direct investment is a crucial component of this process, as it brings in both physical capital and innovation, driving long-term economic growth and productivity. Now we will discuss the policy, trade, and infrastructure, fiscal, and monetary policy. Now let's turn to Germany policy and infrastructure. Since 2020, Germany has implemented expensive fiscal policies. Key programs include the 200 billion defense shield to stabilize energy prices and the 177 billion climate and transformation fund for green investments between 2024 and 27. Additionally, there are targeted subsidies for electric vehicles and semiconductors mega projects, such as the 10 billion subsidy for Intel and 5 billion for TSMC. Now, for the monetary policy set by European Central Bank (ECB), monetary policy is set by the central bank by European Central Bank as mid of 2025. The key policy rate is over 4% to control inflation across EU. While this has raised borrowing costs, it has helped moderate inflation towards the ECB's 2% target. Despite this tightening, Germany maintains strong credit access for sustainable and innovation projects through public banks like KfW and green financing tools. This supportive policy mix reduces entry barriers for capital-intensive projects, making it an attractive environment for long-term ESG-aligned foreign investment. Now, for the trade and investment policy and infrastructure and logistics. Germany is the trade engine of EU, as we all know, with exports making up to 47% of its GDP. Its top export markets are US, China, Netherlands, and France. The FDI regime is very open, allowing 100% foreign ownership in almost all the sectors, with the screening only in critical areas like defense and AI. This is supported by world-class infrastructure. Germany has 13 international airports, a top-tier rail network, and the port of Hamburg is the third largest in Europe. While the country is leader in renewable energy, with the 46% of its electricity coming from renewables. It's still working on expanding its digital e-government services. In 2023, Germany attracted the second highest number of greenfields projects in the world. Now, does the economic policy influence FDI in Germany and regression analysis? To verify the influence of economic policy on FDI, we conducted a regression analysis. That dependent variable was net FDI inflows, and the independent variables includes GDP growth, inflation, and employment rates, export and imports. The model shows a strong fit with an R squared value of 0.83, meaning that our selected variables explain about 83% of the variation in the FDI inflows. Now I will pass over to Kero, who will interrupt these results and provide our final recommendations.
Thank you, Norus. My name is Carlos, and now I'm going through our regression analysis for the FDI in Germany and which variables will affect the economy in Germany. In this slide, as you can see, we choose six independent variables: GDP, inflation, unemployment, export, import, and exchange rate. The goal to find out what is the biggest variables affect FDI in Germany, so any investor will be interested in such analysis. Our analysis reveals several key insights. First, higher percentage of import of GDP is strong and positively associated with higher FDI inflow, suggesting that an open economy attracts investment. However, higher export as a percentage of GDP are associated with lower FDI, which might indicate that export lead firms are less reliant on foreign investment. Inflation has highly significant negative impact on FDI, as investors are held back by price instability. What is interesting here, GDP growth and unemployment rate were not found to be statistically significant in our model. In this slide, market access and consumer base, um, Germany offered direct access to 447 million consumer in European Union. It's also located in the central of Europe, making it easy to ship products across all the region. Inside Germany, there are 83 million people with high spending power, each earning about 49,000 per year. Most people are well educated, living in cities, and use internet and technology, and over 92 of population is delightfully connected. Consumer here prefer high quality, tech-enabled, and sustainable product. This is a big opportunity of foreign companies that offer modern and eco-friendly goods. Now let's go for some analysis like risk analysis, pestle analysis, and final verdict. Starting with financial currency system, stability and access for investors. Germany is part of Eurozone, which gives stable currency environment. This reduces foreign exchange risk. Investor can send profit back to their home country freely with no capital control. And as you all know, Frankfurt is a financial heart of Europe. It's home to European Central Bank and major international banks. All this in Frankfurt. Also, cities like Berlin and Munich are full of venture capital and green finance opportunities. This helps startup and tech focus FDI project grow faster. In short, Germany has low risk financial system. This support both big and small foreign investment. If we now go through risk analysis and mitigation, of course there is risk in any market. In Germany, some current risk include high energy prices and the aging workforce and dependence on global supply chain. But These are balanced by strong legal system, public-private investment, and clear transition to clean energy. Germany is also investing heavily in tech and innovation, which help reduce future risk. If we go full pestle analysis to dig deeper, let me go through it quickly. Political side, stable government and strong rule of law. For economic side, large economy, but slow recent growth. For social, aging population, but highly skilled workers. From technology side, strong in innovation, but digital public service need work. For environmental side, leading in the green transition. From legal side, excellent protection for contracts and IP rights. Overall, it's safe and instructed properly for doing business. In this slide, we'll go through our index, and we named it Germany's Economic Attractiveness and Living Index. We build an index to measure how attractive Germany for investors. This includes three parts. First, FDI attractiveness. FDI over 1,000 greenfield project happened in 2023. Strong legal protection and business friendly environment. Score is 78 out of 100. And for economic side, low GDP growth, it's 2%, but stable inflation and low debt. Score is 70 out of 100. For standard living, excellent education, high income, top 10 HDI. Its score is 86 out of 100. We call this GLE score. And for our GLE index summary, we can see that Germany's attractiveness and living index final weighted score is 78.2 out of 100. What does it mean? Germany is one of the top choice for FDI thanks to high life quality, legal and institutional strengths, and stable economic policies. Even with low growth, the overall environment is safe and rewarding for investors. As a final recommendation for all our project and our research, Germany is a very attractive FDI destination because strong legal and financial system, skilled labor and world-class infrastructure, big public and private investment in future industries like AI, EVs and green energy. But investors should also put into consideration energy transition challenges, ESG and regulatory rules, and shifts in global supply chains. Still, with good planning, Germany offers long-term value investors. Thank you so much for your attention and listening to this. We hope that we gave you a clear view of Germany's FDI environment and why it's strong option with global investors.